Welcome to The Explainer. Okay, today we are diving into a massive wealth arbitrage opportunity, specifically for non-resident Indians. If you're an NRI pumping 25 lakh rupees a year into India, you absolutely need to hear this. We're looking at a strategy that bridges Indian capital markets with a very specific, perfectly legal offshore tax structure. So let's just get right into it.
Look, let's cut right to the chase. If you are putting your hard-earned dollars into regular mainland equity mutual funds right now, you are voluntarily signing up for a massive 12.5% long-term capital gains tax hit when you finally cash out. It's painful. But the data shows that a GIFT City Unit-Linked Insurance Plan, or ULIP, can give you exposure to the exact same market growth, but with literally zero tax at maturity. None. Now, I know what you're probably thinking. Wait a minute, didn't the government cap tax-free ULIPs recently? And yes, you'd be totally right, but only for resident Indians. Residents are strictly capped at a 2.5 lakh premium limit per year. Anything above that gets taxed. But here is the kicker. For NRIs investing through a GIFT City offshore policy, the rules clearly show there is absolutely no limit. You could invest $50,000, $100,000, $1 million a year, and it stays 100% tax-free.
Section 1. The NRI Tax Trap. How mainland investments leak your wealth.
12.5%. That right there is the silent wealth killer. It's the new long-term capital gains tax rate on mainland equity mutual funds. Think about it. You take on all the market risk, you ride out the volatility, and when it's finally time to enjoy your money, the tax man just swoops in and takes a 12.5% slice of your total gains. Over a 10 or 20-year horizon, we're literally talking about lakhs, maybe even crores, just evaporating from your portfolio.
Section 2. The Budget 2025 Loophole. The Section 1010D Amendment.
So what exactly changed to make this possible? Well, Budget 2025 introduced an amendment specifically exempting life insurance policies issued by IFSC offices from those standard premium limits. And this IFSC is located in GIFT City, which is India's fully regulated, sovereign offshore financial territory. It's kind of like having a Singapore or Dubai, but physically sitting right there in Gujarat. And because you invest in US dollars here, it creates this beautiful zero capital gains tax environment specifically for non-residents.
Section 3. The One Golden Rule. The absolute condition for zero tax.
Now, the government isn't just handing out free tax passes without a catch. There is one absolute golden rule you must follow: the 10 times sum assured requirement. Simply put, for the tax exemption to work, your life insurance cover has to be exactly 10 times your annual premium. You put in $10,000 a year, the policy guarantees a $100,000 life cover. And the insurers in GIFT City structure these plans precisely to make sure this parameter is always met.
Section 4. The Tax-Free Math. 25 lakhs per year over 10 years.
Let's actually look at the math here with a parallel investment. Say you're committing 25 lakhs, which is roughly 30,000 US dollars, every year for 10 years. On the equity mutual fund side, your money is tied to the Indian rupee, so you face currency depreciation, plus that brutal 12.5% tax at the end. But check out the GIFT City ULIP side. Your investment is in US dollars, completely shielding you from rupee depreciation, and when it matures, your tax burden is a big, beautiful 0%.
And when you project this out over the long term, the reality is just staggering. Even after factoring in the built-in fees of a ULIP, the post-tax payout of the GIFT City option absolutely towers over the regular mutual fund. You're literally sidestepping a 12.5% tax hit on 10 years of compounded gains. That is pure alpha, guys. You are literally keeping lakhs of rupees in your own pocket simply by picking the right jurisdiction.
Let's be totally transparent here. Section 5. Reality check and rules. Compliance, charges, and lock-ins.
Now, whenever we talk offshore, compliance is the first question. But the good news here is really straightforward. These are fully FEMA compliant. Since GIFT City acts as a foreign territory, you just pay your premiums directly from your NRI account in dollars. And when the policy matures, those funds are entirely 100% repatriatable back to wherever you live in foreign currency. No RBI headaches, no red tape.
But you've got to know the operational realities too. This is not a short-term trading account. This is a serious, long-term wealth strategy. There's a mandatory 5-year lock-in period. You absolutely cannot touch this money during that time. Plus, ULIPs do come with layered costs. You've got fund management charges, age-based mortality fees for the insurance cover, and pretty steep penalties if you try to surrender early. So you have to be committed for the long haul.
And here's why the timing is so interesting. By 2026, we are going to see a massive expansion in Gift City, with new global providers and even ETF structures moving in. The government has actually pushed the tax holidays for these businesses all the way out to 2030. So when you lock into a 10-year policy today, you're plugging into an ecosystem that's mature, fully supported, and expanding super fast.
So the big question I really want to leave you with today is this. Why on earth would you voluntarily leak lakhs of your own hard-earned wealth in mainland taxes when a sovereign offshore loophole was built exactly for you? As an NRI, you have this completely legal, highly protected advantage that residents just don't have access to. The math makes sense, the regulations are rock solid, and the arbitrage is very real.
If you're curious about how these numbers would look for your specific portfolio, let's dive into it. Just send me a direct message with the word GIFT, and I'll send over a free, personalized ULIP versus mutual fund tax comparison for you. All right, that's it for this explainer. Thanks so much for hanging out with me. Stay focused, invest smart, and seriously, stop paying taxes you don't legally owe.